Hey guys, do you want to learn how to buy your first rental property? Do it zero down. Have you wondered, especially today, there are multiple choices, right? You could buy multifamilies. Do you buy Airbnbs? Or do you buy single family properties? Or even better, do you build new and grow in that way? Well, in this video, we're going to show you the exact properties to buy. How do you do it with zero down? This is Andrew Holmes from 257 Cash Flow. Let's get started. Generally, we have three types of people. People that may have some money, meaning they may have 100,000 or more. Or you may be that category, which is the second category, where you may have 30, 40,000. You may think, oh my God, that's not enough. I really don't have a lot of money. Or you may be category number three, where you don't really have a lot of money. We say zero down, and you're trying to buy a rental property. So is it possible? Guys, I'm telling you, it's possible 100%. We're going to show you exactly how it's done. One thing I'll caution you as we get started is that if you're going to buy a rental property, you're going to be a long-term investor, you need to have a little bit of money put aside. Doesn't have to be a lot, about $5,000 to $8,000 that you can use to get everything in place so you can start producing cash flow income. So let's get into the location of the properties. You may have heard the term location, location, location. But you know, before we talk about location, there's one more important thing. And that is cash flow. Meaning, what are you doing this for? Why am I buying a rental property? And this is the most important thing. Well, your number one goal, first goal should be, hey, how much would I like to make? I would suggest you want to make $5,000 every single month. That's $60,000 for the year. That should be your goal number one, and that can be done within 2 to 3 years of starting having zero properties. So let's look at some examples of location. Well, when we think about it, today we happen to be in Chicago. When you think about Chicago, a lot of times people think, oh my God, Andrew, high crime. Well, if you look at the city, it's about 4 to 5% of the entire Chicagoland area that's going to be high on crime. Yet, rest of the town, not the areas that are very expensive, but the rest of the suburbs make for an excellent location, a huge employer base, and a lot of reasonably priced housing in relation to rent. See, you always have to look at the price of the house versus the relative rents. So if I was going to pick a city, instead of Dallas, I'm going to look at parts of Houston that are more economically feasible, where I have reasonable pricing structure as well as relatively high rents. How about San Antonio? How about some towns that are exterior, that are kind of on the tertiary markets to these bigger cities? See, when you're in the hottest part of the city, there's too much attention being paid. What you want is kind of where the cows are to people. You want that middle sector, because that's where you get the best pricing and you tend to get the highest rents. Hence, you get cash flow as well as appreciation in those markets. So when you start investing, those are the markets that you're looking for, not the hottest and not places where people don't live. You want kind of the mid-sector in that particular market. So now that we understand location, we have to understand, who are you? Where are you coming from? So what do I mean by that? Well, are you somebody that has a W-2 job or is a 1099 employee where you can prove last 2 years' income? Or are you somebody kind of like me today, right? Are you an entrepreneur where you are self-employed and you kind of dictate your own schedule? Or are you in the third category, which is, Andrew, I don't really want a job. I really don't want to do anything. I just want to be a millionaire, right? If you are in the third category, maybe watching this video may not be the best thing for you. Maybe pick a religion and pray and hope to win a lottery ticket. But if you're in the first two categories, meaning you're somebody who says, you know, I can keep a job, or I'm somebody who's self-employed and I understand that building wealth is going to take a little bit of time. And when we talk about time, we're talking about next 2 to 5 years if you genuinely want to be a multimillionaire and you want to be financially independent. Then I would suggest keep your job or keep what you do going, and we're going to build the cash flow income, which is your rental income on the side, so that once you're done, you're in a position where you're not running on the treadmill. Other people run on treadmills that you own. So what is the number one method of buying a property? Now, this may not be for everybody, but how about considering buying it as a primary residence? You may be a young family, or you may be just somebody that's moving to a new state, let's say Florida, and you're starting out. Could you buy that property as a primary residence and after a year of living in it, move out of it? Well, why would we consider doing that? Well, you could buy that property with 3.5% down. And I know you're saying, Andrew, but you promised you'd show me how to do it for zero. We're getting there. But initially, how about considering buying the property 3.5% down? Or how about buying a property that is a value add? So what do I mean by that? Well, a property that needs some work where you can buy it for, say, $100,000 or $150,000, do $30,000 or $40,000 of work. You know, the best part is this, that you can buy that and the lender will let you buy the property with 3.5% down, just as you were buying your personal residence. That's called a 203K loan, and any homeowner can buy the property. You know, the best part is you don't have to do the work. A contractor can be paid to do the work for you, and that property that you bought for $150,000, you did $50,000 in work. Today is worth $250,000 or $300,000. You could live in it, enjoy it with your family, move on to a bigger and better property, and rent this one out, make it cash flow every single time. Now, there's a third method when we talk about primary residences. How about doing a house hack? Well, what is a house hack? Well, you buy a duplex or a 3-unit or up to a 4-unit property where you move in as a family and you rent the other unit or other 2 or 3 units out, and they are going to subsidize your living expenses. That's even better than zero. Think about it. You get to live in one, you rent out the other 2 units, and you pay zero, and they are paying for you to live in. That's the first step of owning a treadmill that other people run on. Think about it. Your tenant is going to work, and they are paying your mortgage. So primary thing I would consider, if you don't already have a primary residence, buying your first property as a primary residence, either converting it into a rental after the first year, moving and upgrading for you to have a nicer house, and your tenant pays for your property, or doing a house hack. The second method of buying a property is with a home equity loan. So if you already live in a property and you have a little bit of equity, you could pull out that equity from that particular property, use that equity as a down payment in your first rental property. That's exactly how I got started on my first rental. See, I didn't know the zero down method at the time, and so the way I did it was, I kind of didn't know how to do a house hack. I wish I had, but at the time I didn't. The only way I saw at that time was I took a small $25,000 loan from Chase, used that money to put down as the first rental property that I bought, and then I fixed that particular property after I purchased the property, and then I refinanced it. So we call that the two-step method, but that we're going to talk in the next segment. So now we're finally ready. How do you really buy a property zero down? So let's first understand, what do I mean by zero down? Well, by zero down, what I mean is that after I buy the property, I get the property rehabbed, I put tenants in it, I don't want to have any money stuck in it, because think about it. If you really don't have any money to start with, or if you may have a little bit of money, or maybe even $50,000, $60,000, $100,000, if you buy 1 or 2 properties, leave money in there 20%, what's going to happen? You're going to run out of money. So people with no money couldn't even get started. People with little money maybe buy 1 or 2 and they're out of money, right? So the reason we use the zero down method, or how we buy, is it's called a two-step. So we're going to buy the property, we're going to get it rehabbed, we're going to increase or force the value up of the property, and then we're going to rent it and refinance it. So we're going to do what is called a 100% money recycle. So you're going to do a 100% recycle formula, where you're going to buy the property on the front end. And I know you're wondering, you're like, Andrew, but where am I going to get the money to buy the property? Maybe I don't even have equity in my own home, or I don't want to touch the equity. Guys, it's called private money. If you don't have a list of the private money lenders, make sure you reach out to us and we'll be happy to make you available. There are thousands and thousands of investors that are right around you that have private money. They would love to lend on your deals. The problem is, a lot of times when people are getting started, they don't have the courage, they don't know how to ask for it, and they don't know anybody that would be willing to lend private money. See, the best method today is to borrow private money on the front end to purchase the property and to rehab the property. What are you doing? You're doing OPM, which is other people's money. Now, because you borrowed, let's say in this case, $150,000, $120,000 to buy the property, another $30,000 to fix the property, now your property needs to be worth $210,000, $220,000, or $230,000, significantly more than the amount of money that you have invested in the property. That is 101 of investing. Now what I'm going to do is I'm going to go out and rent the property out. And hopefully you've done your homework, which is if your mortgage on the property is $1,500, hopefully your rent is a minimum of $2,000. So what do you have? You have a $500 cash flow, or a delta, meaning the difference between your mortgage and the difference between what you're collecting on rent. That's called the delta between the two, or the margin, whatever word you want to use. And then guess what you're going to do? You're going to refinance the property, you're going to pay off your first lender, and you're going to put a nice long-term loan on it. Now, this is where it really starts getting exciting, because now you have your property number one. And you're going to be smart because you're a smart investor. Guess what you're going to do? Now you're going to start on the 257 program. You're going to wait for 4 to 5 months. Why am I waiting? Why don't I just go do this again, Andrew? Well, here's the reason. What you're going to do is you're going to wait a little bit. You went through a process, right? This hasn't been easy for you. Now that you've been through the process, you're going to wait for 5 or 6 months. You're going to let that $500, $500 every single month come in. We call it the little kitty. Right? You have about 6 months worth of little kitty set up. So what if the air conditioner dies? What if you need to buy a washer and dryer? You already have some funds that are set aside. Month 5 and 6, now you're going to start looking at another property. You're going to repeat the same process over again. The second time, the third time, fourth, and the fifth. So by fifth time, you have about $2,500 to $3,500, depending on how astute you've been in picking the quality of properties that you've purchased. Now, this is the exciting part. Now you're going to wait again 6 more months. Now, why are we waiting again? We just got through 5 rental properties. Now I'm actually in the business of owning rentals. Well, what you're doing is now you actually have properties. Every single month you have a couple thousand, 2,000 to 3,000 coming in every single month. You're going to let it build up again. Once you have 6 months reserve, now we're going to start the accelerated pay down of the properties, which goes back to the idea of 2, 5, 7. So what I mean is in 2 years, imagine being able to own 5 properties and getting them all paid down in 7. Now, I know if you consume a lot of YouTube videos, you say, but Andrew, you know, this person told me, never pay off your mortgage, keep big mortgages. I understand. But guys, are you the person that wants to have lots and lots of mortgages on your head? Or are you that person that says, you know, I'd like to have 5, 6, 10 properties that are completely paid off, and then I can go on an adventure of growth? See, my belief personally is this, that if you need $5,000, $6,000, $7,000 every single month in terms of cash flow, have those mortgages pay down at a relatively quick pace. Because then not only will you have the freedom of cash flow, you'll have the freedom of time. Once you're at that stage, now you can continue on growing and you can take all kinds of adventures with your money. But don't do it at the price of freedom for you and your family. It's really important to understand that when we're building, there's a stage of building, then there's a stage of pruning, meaning we're going to kind of clean up the properties, and then there's a stage of real enjoyment. If you're the type of person that's willing to have a little bit of patience, guys, it takes 2 to 3 years if you do this correctly. If you want to learn more, you want to see more of these videos, they're 100% free. Follow us. This is Andrew Holmes from 257 Cash Flow. Talk to you soon.